So today we're going to be picking up where we left off in class last time. Due to the weather, we're not meeting in person, so you'll just watch this whenever it's safe and you're able to do so. Today we're going to be wrapping up chapter 2, so we'll finish our discussion briefly on the statement of cash flows, round out the financial statements overall. I'll quickly walk through the links between the 4 financial statements themselves, going through the correct order of preparation and why they must be prepared in that order. And then we'll work a few problems where we actually prepare some of these statements just so we can kind of get our hands into it and see how this stuff all works together. All in all, should be a pretty interesting day. So let's go ahead and get started. So the last slide I believe we covered in class was this one, where we actually went through an example of a real company's statement of cash flows. And what we said here was a couple of things. We said, one, we liked that they had positive operating cash flow. That's that 1389 number right here. That tells us that the company is generating positive cash from their main thing that they do. So from, in this case, Lululemon, it'd be selling their clothes, for example. In our next section, we were pleased to see that we had negative investing cash flows because this is a sign that the company is investing in the future. They're actually acquiring more long-term assets because they're spending cash to do so. That's generally seen very positively. If we have a company and we think they should be trying to grow and they've actually got positive number from investing, jeez. In many cases, we would think that would be potentially problematic, because that would indicate that they were maybe selling off their long-term assets. And once they've sold them, of course, they can't use them again. So that could be an issue. But in this case, so far, all signs point toward a healthy company from the cash flow perspective. We've got the positive from the operating, the negative from investing. We come down a little further and we look at the financing section. And once again, we said there's not really a rule here for what a healthy growing company should look like. If they need additional funds, maybe to procure some of that cash that they're using for investing purposes, then maybe we issue some stock or some bonds, or maybe if we're doing really well, we pay down some debt, or we issue a cash dividend, or we do something else. So positive or negative in the financing section doesn't necessarily tell me a whole lot. It just kind of works as a filler. At the end then, what we come down to is we see, and let's get this out of the way because it's kind of blocking what we need. This 1260 number is their cash balance at the end of the new year. So this is where we should be able to tie that back to the balance sheet, and we should have some synergy between those two. All right, moving on then. What is happening here is the other 3 financial statements that we look at, the income statement, the statement of retained earnings or statement of stockholders equity, if we do the full one, and the balance sheet are all prepared on what is called accrual basis accounting. This is where we recognize revenue when it is earned, and we recognize expenses when they are incurred, as we've already talked about. The difference is the statement of cash flows actually operates on what is called cash basis accounting, where it's really just more interested in seeing, did the cash come in or did the cash go out? And so we have to do some reconciling, which is what makes the statement of cash flows a little different. So in this case, the accrual basis, of course, is recording regardless of whether we receive cash or not, where cash basis is often used by smaller companies that are not publicly traded, like a mom and pop shop, a little corner gas station if it's not like a big chain, etc. And so they just use cash because if they receive cash, they call that revenue. And if they pay cash, they call that an expense. It's not accurate for our purposes, but it is often used by smaller companies. And so this is what we see. All right, continuing on. You can look at that if you want to, but here's a few more examples about the operating section. So cash inflows from operating activities include the sale of goods or services to customers. So once again, this is our core function. This is how we generally do things. And it also include interest and dividends from investments, which is really interesting because the investment itself would go to the investing section, but the interest that's generated from that would actually be an operating inflow. So we have to parse that out just a little bit. Outflows include things like the purchase of inventory, the payment or the accrual of the salaries, the interest that we pay on debt, income taxes that are paid, etc. But largely, these are the things that result from activities that go on the income statement. Investing activities are generally the inflows would be sales of equipment, buildings, other long-term assets, sale of investment security, so it's right there in the name, and collection of loans. So if we had loaned money to somebody and they repay that, that would be an investing activity. Outflows here, the purchase of long-lived assets, so things like, once again, business buildings, equipment, tractors, machinery, all that kind of stuff. Often called CapEx for capital expenditures. Purchase of investment securities such as stocks, bonds of other entities. So we could be on the other side. Instead of us selling those items, we could actually be purchasing those items and investing in other companies. Inflows and outflows of cash related to the acquisition and the disposition of the long-term assets. Now, I do want to make one clear point here. Once something is classified into a category, it never leaves that category. Example, and probably one that I'll put on the test, is if I buy a, say, building, then the purchase of that building is clearly investing. We've seen that already. What we may not understand is the sale of that same building is also investing. Here's where that gets tricky. I might write on an exam, ABC company sells a building to finance the purchase of a new piece of machinery. And because of the way I've written the question, you will be tempted to say this is a financing activity because I even told you in the question this was to finance something else. That's not the case, though. What has happened is this is a long-term asset. When it came in, it was an investing activity. In that case, it would have been a cash outflow because we would have been paying cash to procure the item. And now when I actually sell the item, well, I'm receiving cash, so it becomes an inflow, but it stays in the investing section. So don't let me trick you. I'm almost guaranteed to put that either on the first exam or one of the later exams. You will likely see that almost identically worded question on at least one of your exams because I really like it to see if you really understand how the statement of cash flows functions. All right. Next, we're looking at the financing activities. So once again, this is going to be our long-term equity and our long-term, or not long-term equity, our equity and our long-term debt. So that's going to be where we see these bigger things. So this is stuff like stockholders equity, all those transactions. So the issuance or the repurchase of stock will go here. Dividend payments will go through financing. Any kind of long-term borrowing. So if we issue a bond, if we issue a note for ourselves, all of that stuff would be a financing issue. Okay. So once again, 3 classifications. First is operating, second is investing, third is financing. The way we're going to remember this is with the saying, oops, I forgot. OIF for operating, investing, and financing makes the saying for oops, I forgot. This one's particularly useful, I think, because it's something you might actually find yourself saying just naturally on the exam. And you'll go, oh, hey, that's exactly what I need. And it'll get you back on track. So I really like that saying. I think it'll help you a lot. All right. Changing cash, of course, just the difference between the balance of cash at the end of the current period and the balance at the beginning of the period. One quick note here, the balance at the beginning of this period will simply be equal to the balance at the end of the prior period. So nothing is going missing between periods. Whatever we end, say, December 31st with at 11:59 p.m. is exactly the amount we should start January 1st with at 12 o'clock a.m. And so there should be no leakage there. They will be exactly the same. So this is a wording thing that you got to watch out for on exams. I might give you the beginning balance for the current year, or I might give you the ending balance for the prior year. Either way, I'm giving you the exact same piece of information. So you should be able to read through that and understand where that information is useful. All right. Part D. So the statement of stockholders' equity is the last piece here that we want to look at. So it's got a couple of pieces. We've already talked about contributed capital in class. This is, for example, the common stock account and the additional paid-in capital account. Retained earnings, which is just the sum of all prior and current period net income minus all prior and current period dividends declared. So it's the earnings that the company has generated from the income statement since inception all the way to the current point in time, minus any dividends they have declared. And I'm being very careful here to say dividends declared and not dividends paid. That's mostly so that later in the semester, when we talk more about dividends, you're not confused. The distinction right now is maybe relatively minor, but it will become far more important as we get later into the semester. And so I want to make sure from the beginning we are consistent in our verbiage so that you do not get confused. All right. Next, we have accumulated other comprehensive income. And I'm not going to worry about that at all in a principles course. If you take me or someone else for an advanced accounting course or an intermediate accounting course, that will become much more important. And if you are an accounting major, go ahead if you want to read that section of the book. It's fine. You're not going to be tested on it in principles, though. I'm not going to test you on it in principles, at least. I don't know about the other professors, but I believe that to be a concept that is just a little bit outside of the scope of a principles course. So here is an example of the statement of stockholders' equity. Once again, for Lululemon, we can see a couple of things here. So if we look initially, we see their beginning balance in common stock, very small, and their beginning balance in additional paid-in capital is quite large, at least in comparison to the common stock amount. And this is very common, as we talked about in class, because what happens is there, in many places, it is illegal for companies to sell stock at a value below what is called the par value. The par value is just this minimum legal amount that we assign when we begin the company. So when I file all of my initial incorporation paperwork, I have to assign a par value to my stock, and it really is just a numbers game. And so the issue is if I can't legally sell my stock at a price less than my par value, I have a very good incentive to make that par value extremely small. So most companies will make this something like $1 or a cent or some fraction of a cent, are all very common par values. And so basically what they're doing is they're saying, hey, no matter how bad our financial situation gets, I want to keep the option on the table to be able to issue stock to raise capital if necessary. So the common stock account only contains the portion that is assigned to the par value, where additional paid-in capital contains everything else. So for example, if I issue a share of stock for $10 and it has a $1 par value, then only $1 goes to the common stock account, but 10 minus 1, or $9, goes to additional paid-in capital. And so you can see how this can very quickly get lopsided, as you see here. All right, good enough for now. Next, we see their beginning retained earnings. So you can tell that over the time of the company, they have been profitable. They have a positive number here. They've got a negative for AOCI, but once again, we're not really going to worry about exactly what this is for a principles course. This is, in my view, well beyond the scope of what we need to cover in this class. We've got plenty of other stuff we have to cover. I think that's pushing a little too far, even for me. All right, now we see our total stockholders' equity, just the sum of the row all the way across. Next, we see the current period's net income of $975. So that's pulling through here. We see there was some stock-based compensation and some stock issuances that came in, increasing additional paid-in capital. And we bought back some stock, which reduced the additional paid-in capital. So we can come down, add all this up, and we get to the total amount for stockholders' equity at the end of the year. Notice this is different from here because this is the beginning balance. So they began the year with stockholders' equity of $2,559 million, and they're ending the year with $2,740 million. And so they had a pretty good year. Their stockholders' equity went up. So that's a good thing. All right, let's clear off all these annotations, and we'll go ahead and move on to the next slide. So primary components of the stockholders' equity statement are, of course, common stock and additional paid-in capital, retained earnings, and then, once again, we're ignoring it, but it is technically there, accumulated other comprehensive income. I think it is important that we at least mention it exists so that if you are working on your 10K project toward the end of the semester and you see it, you don't panic and go like, what is this? I'm just going to tell you, basically, don't worry too much about the AOCI stuff. I don't think it's relevant. So we'll go ahead and continue. Okay. Now, I do leave this slide here just for us to make a few quick notes. And it's because I want to show you very briefly, and I do apologize both for the speed this is about to happen at and the quality of the writing, because it's probably not going to be very good because I'm trying to write with a trackpad, which I'm not super great at, but hopefully the point is made. And if you have questions, as always, feel free, send me an email. I'll be happy to answer any questions you have. But I think going through the financial statements as we've done so far can be a little bit confusing. And so before we get into actually preparing them, I want to take a moment, or maybe 5 or 10 minutes, and just clarify exactly why these financial statements are important and how they are interrelated. So how do they relate to one another? So we'll start off with the first one that we are to prepare, and that is the income statement. So the income statement is our first financial statement. And if we're doing this very, say, basically, then what this is we're just going to say this is going to be revenues minus expenses, and this will equal net income. And that's it. That is, at the most basic level, what the income statement is. Now, we'll get into more technical detail in just a minute when we actually go through the handout. But for now, this is the baseline overview of what is on the income statement. Revenues and expenses. Of course, gains and losses as well. But once again, we're keeping this very clean for this overview slide. Now you say, okay, why do we have to do that one first? And it's because if we think about what the second one is, the second financial statement is the statement of stockholders' equity. And the statement of stockholders' equity largely does this. We start with beginning stockholders' equity. We add in current year net income. We subtract out current year dividends declared. We add in any common stock issuances. And then this will come down and give us our ending stockholders' equity. Now, why is it necessary for me to have prepared the income statement first? Well, if you're really locked into this stuff, you probably already see it jumping off the screen at you, and hopefully you do. And it's because of this right here. I have to have my current year net income, or I cannot complete my stockholders' equity statement. Where do I get that from? The end of my income statement. And so now we see very clearly why I needed the income statement complete before I could finish my statement of stockholders' equity. All right, moving on then. Our next financial statement that we want to deal with is the balance sheet. And the balance sheet has a couple of pieces to it. If we start very generally, we have assets equals liabilities plus stockholders' equity. That's the fundamental accounting equation that we covered probably on the very first day of class. But at its most basic level, it is the balance sheet. This is what we're trying to show, this fundamental relationship. Now, why was it necessary that I finish my statement of stockholders' equity first? Because part of the stockholders' equity section includes the ending balance for retained earnings and the ending balance for stockholders' equity. So let me see if I can get this to cooperate. Oh my goodness. Here we go. See if we can get this to wrap around. It's not wanting to cooperate. Okay, so we'll try again. I'm not sure why it's such a large font size either now. Let's see. Okay. So the big piece of information that we need here is we need the ending balance for stockholders' equity. And where do we get that from? Well, we get it from right here. So if we come over, we can see that this balance will flow from right there. And that's the big piece of information that we need. Now, oftentimes we'll simplify this and I'll say, oh, we just need the updated retained earnings number. And that's fine. But truthfully, what we're really getting is we're getting that ending equity figure, because otherwise we just have the beginning number. And the beginning number will not force this thing to balance. We need the updated ending number. And then our last financial statement that we have here is the statement of cash flows. And when we do the statement of cash flows, here we are tying the ending cash balance from the balance sheet to the ending cash balance on the statement of cash flows. Now, what this means is there is a system of internal checks between these statements that allows us to make sure these things have been completed correctly. It's why they have to be prepared in this order. Now, this leads us to a really handy mnemonic, which is I should be sleeping. ISBS. I represents the income statement. Should represents the statement of stockholders' equity. B represents the balance sheet. And sleeping represents the statement of cash flows. Now, admittedly, there are two S's in this mnemonic, so you could get the two statements confused. I think if you take the time to understand the overall flow of the information, though, you will not get them confused because you will understand that you would not be in a position to prepare the statement of cash flows second. You would need to do that one last. So this is the overall order, and this is why they are prepared in that way. So if you have questions about any of this information, make sure you let me know. I'll be happy to answer any questions you've got, but this is the basic structure of why these statements go in this order. And hopefully this mnemonic or this saying here will help you to keep them in order as you prepare for the exam. Very common question that I will ask has to do, of course, with that order of preparation. And so I want you to make sure you understand both, just able to list them. If I were to say which of the following list the financial statements in the correct order of preparation, you should be able to do that. But more generally, you should be able to explain why those financial statements have to be prepared in that order. So hopefully that clears up any potential confusion there. Okay, with that done, we are going to exit the slideshow. And I'm going to stop sharing just for a second to make sure I get the share on the correct file for next. And we're going to work through a few examples. So here we go. Let's make sure we've got the share correctly. I don't want to, in the past, I've accidentally recorded these with the wrong window shared. And that's very frustrating for me as well as for you. And so now I try to be a little more careful on the front end just to make sure that everything goes smoothly. All right. Just for the nature of how this is being done and for brevity, and so it's hopefully more clear and it's easier for you to take pictures or something if you want to, I'm going to just use the solution file for this. That way you're not having to wait on me to type and hear me type on the video because that's not super pleasant for anybody. And so I'm just going to walk through the solutions file, but anything in here is absolutely fair game for the exam. Once again, in the current structure, and if you're taking me in a semester that's not right now when I'm recording this, you might check and make sure this is still true. But at least in the spring semester of 2026, when this is being recorded, your exam is entirely multiple choice. True, false, etc. I mean, it's something that boils down to a selection. So the way this will be tested might look a little different, but certainly all the things we're about to do are things that you could be expected to do on the exam. So once again, if you have questions, make sure you reach out, make sure you ask those. Okay, here we go. Starting off, we're going to start with the most basic type of balance sheet, which is what is called an unclassified balance sheet. This is generally not used in practice very often because it's not super helpful. And so we'll then talk later about the other type, which you can probably guess. If this one is unclassified, the other type likely is classified, and sure enough, it is. And so we'll see that in just a little bit. But to start with, here's our unclassified balance sheet. Wolfpack Construction has the following account balances. Now, I strongly encourage you, if you're taking the exam, to take a few minutes or a few seconds. It shouldn't take probably minutes, but when you're asked to prepare a balance sheet or an income statement or anything else, you should take a moment to identify what you're trying to accomplish and which accounts will actually be necessary. Now, if we take a quick scan down this, we might notice there's a few accounts here that do not go on the balance sheet that are included. And so we want to make sure we don't get fooled into doing that. Now, once again, this is unclassified. So my classifications don't have to be super precise. They just have to be good enough. So we start off with equipment. So what type of account is equipment? Well, equipment is something I will use in the future to help me generate revenue. So equipment is an asset. Accounts payable, though, we look for that keyword payable, and that tells me it is a liability. Salaries expense is an expense, so that's an E. Now, the problem with that is expenses do not go on the balance sheet. So for right now, I can just draw a line through this entire account and get rid of it. It is not necessary for this problem. Many students might mistakenly take that and force it into the balance sheet somewhere. It will mess up your balance sheet and things will not be done correctly. So do be careful. Next, we see common stock. Well, common stock, of course, is a stockholders equity account. So we will be able to use it. I don't know why it's not letting me write all of a sudden. It's a stockholders equity account. So that one's fine. Land, of course, is another asset. Once again, I'm trying to write with the trackpad, so this is not going to be my finest handwriting, but hopefully it's good enough that you can follow along. Notes payable. Once again, we see our favorite keyword here, which is payable. And so that tells me this is a liability. Revenue is another word that we see here. And we, of course, remember revenue is, well, a revenue. And because it's a revenue, it goes on the income statement, not the balance sheet. So we do not include it for now. And cash, of course, is an asset. Now, this retained earnings number, we will need it. And interestingly enough, because they did not give me the new balance, we might actually need to go back and use that revenue and expense information indirectly, even though they won't show up on the face of the balance sheet. So temporarily, I'm going to undraw a line through these just so that we can see those numbers in case we do end up needing them, noting they will not fall directly on the face. But let's move on and see what happens. So first things first, let me get where we can move down the page to see what we've got. As expected, we have our assets. We have cash, we have land, and we have equipment. Those are the three assets that we identified. Now, admittedly, this is an unclassified balance sheet, but as good practice, we still start by listing cash first, just because it is normally the first asset we should see. After that, we just lump the other assets in really in any order we can here. For the liability section, we had two. We had accounts payable and we had notes payable. So both of those come in. So now we see that we have total assets of $50,000 and total liabilities of $23,000. Next, we look and we see our common stock of $11,000. So if we do 11 plus 23, that would be 34, but I need to get to 50. So that means the only other account that I don't know the balance of is retained earnings. So now I can say, well, I need another $16,000, and that must be into retained earnings. And sure enough, that's how we solve for it. We say assets are 50, liabilities are 23. Our common stock was 11 plus our retained earnings. When we come back, we can do 50 minus 23 minus 11, and that gets me to 16. Now, notably, in this problem, you would have run into an issue if you tried to simply take the 39 minus the 33, and that's because this is not the company's first year in operation. So you did have to be a little careful here. If you tried that, you would have gotten 6,000, and your balance sheet would have been out of balance. What this means is they did not tell us that there was actually a beginning balance in retained earnings of $10,000. So while this is a relatively straightforward problem, there were still a few little twists and turns along the way that made it a little bit more interesting. So we'll go ahead and continue. Well, once again, if you have questions, always feel free to reach out. I'll be happy to help. All right. For our second question here, we're going to be looking at classifications on the balance sheet more specifically. So now we're trying to split things between current assets and long-term assets, and current liabilities and long-term liabilities. So let's see how that works. We start off with accounts receivable. Accounts receivable is, first off, before we can do anything, we have to determine, is this an asset or a liability? And in this case, of course, it is a an asset because we see the keyword here, receivable, indicating that someone will pay me in the future and I am set to receive some amount of cash. So we see this is clearly an asset, but now the question is it current or long term? The way we determine that typically is by the first word, accounts. Accounts are generally informal and very short term. As a result, we can state that this is in fact a current asset. Next, we look and we see prepaid rent, which prepaid expenses we know are the least liquid of our current assets from our mnemonic in class last time. But we also see 6 months. And as a result, this is a current asset because current assets are things that we expect to use within 1 year, that would be 12 months, or the operating cycle, whichever is longer, meaning that anything within 12 months is always considered a current asset, though there could be instances where something that's not used for, say, 15 or 16 months could also be, but those would be more rare. Next, notes receivable. So once again, we see receivable tells me we've got an asset. But as soon as I see note, I start to perk up a little bit, thinking this might be a long-term asset. And sure enough, in this case, it's not due for 2 years. So whoever owes us this money will not pay us for 2 years. And as a result, this is our first example of a long-term asset, or you could also see this referred to as a non-current asset. The terms can be used interchangeably and they mean exactly the same thing. Next, we see notes payable. So once again, we're looking for a keyword. We see payable. I see notes, which makes me think, hey, this could be long-term, but what do I see next? 90 days. Well, 90 days is certainly less than a year, so this is a current liability. Next, we see notes payable due in 5 years. So once again, we see the keyword telling us we've got a liability, which is payable. And we see the term here, 5 years. This is a long-term liability, And finally, for patents, this is a long-term asset. Specifically, it may be reported separately from the other long-term assets as what is called an intangible asset. But for this point in the course, we can just call this a long-term asset. So that's what we've got for here. So we can see, sure enough, current asset, long-term asset, current liability, long-term liability, long-term asset. So we did, in fact, get them all right. And so that's pretty good. We're off to a good start. So once again, if you have questions, make sure you let me know. Next, we're going to prepare our first income statement. And notably, this is what we will refer to as a single-step income statement. And much like the balance sheet, which had unclassified and classified, hopefully you can guess that if this is a single-step income statement, the alternative is likely the multiple-step or the multi-step income statement. Both income statements will give you the same amount for net income, but they serve a different purpose. The single-step income statement effectively lumps all revenues and gains into one number, and then all expenses and losses into one number, and then does one layer of subtraction, and we come down to income. This is fine, but it's not very transparent because we're not clear on where the revenue really is coming from. Is this something that can be repeated? Is this a one-time event? It gets really messy, and it gets hard to make useful decisions from. The better income statement type for most applications is the multi-step, which provides you with various subtotals, things like gross profit and operating income and income before taxes, etc. And so we can see a more granular version of the same facts, sure, but it makes it a lot easier to make informed decisions. All right, with all that said, let's go ahead and begin. MMT Corporation reports the following income statement items in millions of dollars for the year ended 12/31/26. Sales revenue, $2106. Cost of goods sold, $1240. Selling expense, $126. General and admin, $105. Interest expense, $40. And gain on sale of investment, $45. Income tax expense has not yet been recorded, but the income tax rate is 25%. So here we go. We'll start off with our first section here. Once again, this is a single step income statement, so all revenues and gains go into one bucket. And so we only had two items here. We had sales revenue given to us immediately for 2106, and then we had a gain on sale of investments for 45. So if we want, we can go back and we can identify those two. Here's the gain for 45, and here's the initial sales revenue for 2106. That comes down to give me the 2151. So we can see where all of that is coming from. Now we'll use a different color for our expenses and losses. And so now they tell us our cost of goods sold was 1240. So we see that. Our selling expense, our general and admin. I don't know what is going on with this, not letting me. There we go. General and admin, our interest expense. And so we see all of that, the 1240, the 126, the 105, and the 40. And this comes down to total expenses and losses of 1511. That difference now gives us income before tax of 640. We then have to actually compute income tax expense. They told us, though, that is a 25% rate. So we'll take 25% times 640. So that would be 640 times 0.25. So the other way, of course, you can do this is to say 640 times 0.25. And that would also give you 160. So if you think in terms of percentages, you can do 25%, but do be careful and don't actually multiply by just straight 25, or you will, of course, get a much larger number than you intend to. So in this case, we will do 640 minus 160 to get 480. Now, I will make a slight correction here to my key. This really, if we're going to keep this without the parentheses, this should say less on both of these. That way we are clear that these are actually being subtracted. If you don't want to include that word less, you could just put the 1511 and the 160 in parentheses, as we discussed last time, indicating these numbers are being subtracted. I would encourage you not to do both, as then you would be subtracting a negative, and that could be confusing. So in this case, 640 minus 160, we come down to net income of 480. All right. With that said, we are now going to prepare with the same facts that we just used, instead of the single step, the multiple step income statement. To do that, we will go ahead and cheat a little bit and show ourselves that indeed our net income will remain unchanged at 480. But I think you'll agree that we find a much better division of the information in this presentation, and it would be much easier to make informed decisions. So let's start off. The core function of the business is, in this case, to sell their products. The cost of selling those products goes to an account called cost of goods sold. It's literally the cost of the goods that were sold. Very straightforward. We'll take the initial sales revenue minus that cost of goods sold to get our first big number, gross profit. Now, notice also, we do not have dollar signs, for example, in every number. We only have them at the top of the column and at the very bottom if we have an ending total. This is largely because of the monetary unit assumption that we talked about in Chapter 1, where we said, once I tell you how this is all denoted, you don't need a monetary figure for every single individual line. I can assign it at the top, and then you will know that that flows all the way through, which just cleans things up a little bit. Now, we'll go ahead and start off. Sales revenue less our cost of goods sold of 1,240 to get us to gross profit of 866. We'll now bring our selling expense of 126 and our general and administrative expense of 105, and this will give us what we refer to as our total operating expenses of 231. 866 then minus the 231 will come down to be $635. So this is our operating income. This is the portion that is derived directly from our operations and that can be easily repeated into the future period. Why? This is the stuff that we do every day. And from that, we generated income of $635. Next, we have another section called Other. This is stuff that is not necessarily repeatable. These could be one-off events. I sold a building for more than it was worth. I bought a car, or I did something else and I got a bad deal, etc. Gains and losses will largely flow in here, as well as things like interest expense. So let's see what we've got. We did indeed have a gain on sale of investments. So we bought an investment at some price and we sold it later at a higher price. That's referred to as a gain, specifically a capital gain of $45. That goes in. And then we paid some interest, or we incurred at least some interest in the amount of $40. So 45 minus 40 will indeed be 5. And so now we have additional income of $5. This gives us income before taxes, as we expected, of $640. And then we find, of course, the income tax expense is the same 160 as before, and our net income is 480. So in the end, we get to the same position, but notice this provides much more useful information, where on the other hand, we really only had this 480 to go by. We now have several other useful figures that might provide additional information if we needed it. Okay, with that done, we can go ahead and continue on. So next we will look at the statement of cash flows. So we'll first calculate the ending cash balance, and then we'll prepare the statement. So here we go. Tiger Trade has the following cash transactions for the year. First, they received some cash from the sale of products to customers. So as we did before, and let me see if I can get this to let me type. Don't know if it's going to let me. Sometimes it gets a little finicky. That's fine. We'll just keep writing. All right. Cash received from the sale of products to customers. Well, as we remember, there are 3 classifications on my statement of cash flows: operating, investing, and financing. So those are the 3 sections that we will be dealing with here. As we did with the balance sheet earlier, I will strongly encourage you to think through these classifications as you go through the assignment. So first, cash received from the sale of products to customers. That is absolutely our main thing that we do. That will be operating. Cash received from the bank for a long-term loan. So we went to the bank, we took out a loan. That's a long-term liability. That is indeed financing. Cash paid to purchase factory equipment. Equipment is a long-term asset, and we paid it. So this will be an investing, and it will be an outflow. Cash paid to merchandise suppliers. That's certainly a day-to-day thing. That is operating. Specifically, it is an outflow. Cash received from the sale of an unused warehouse. Well, a warehouse was a long-term asset. Its purchase then would have been an investing activity, and so its sale will also stay in that investing section. Cash paid to workers. This is like their salaries or their wages. That is operating. Cash paid for advertisements. That is also operating. Cash received for the sale of services to customers. Also operating. And cash paid for dividends to stockholders will be financing. So now we have already done the hardest part of the problem, which is just figuring out where each one of these items actually goes. Now, as with the balance sheet problem earlier, it is entirely possible, maybe even likely, that if I were to do something like this on an exam, I would include several transactions that don't actually fit here in any way, shape, or form, and you would have to know to exclude them. But for our first problem, I think it's helpful to give you one where everything has a nice clean home. All right, here we go. Starting off then, first calculate the ending balance of cash, assuming the beginning cash balance was $5,000. So this, very easy, very tedious though. So we're just going through. If we had a positive number, we add it to the 5,000. If we had a negative number, we subtract it. And when we do all of that, we come out to an ending balance here of $37,000. All right, easy enough. We'll go ahead and move on then. Now, here we use what is called the direct method. The direct method is used less frequently in practice than the indirect method, though there has been some recent research done on the direct method that suggests it provides more decision useful information, so that may begin to change shortly. But at this time, the indirect method is still more popular and is the method that we will use toward the end of the semester when we really begin preparing a lot of statements of cash flow in the chapter directly on the statement of cash flow. But it doesn't hurt to do one quick example early in the semester of the other method, just in case you come across it. So the way this works is we start with our operating section. And everything we identified that went to the operating section comes in here. And if it was a positive number, it will increase this value. And if it was a negative number, of course, it will decrease this value. So we now see all of those items come in. And we have net cash flows from operating activities of $30,000. If you need to go back, I strongly encourage you to do so. Maybe take a picture of those classifications so that you can match that up here as you go through to make sure you're following everything cleanly. But you can certainly do that, or you can just scroll back in the video a few seconds as you need to. All right, once we finish the operating section, we move to investing. For the investing section, we see here a negative cash flow from investing, which we said is generally what we should see for a healthy company. Because if the investing cash flows are negative, that tells us that the company is actually investing in themselves. They are buying more long-term assets than they are selling, for example. So we do have a negative cash flow here, or what is referred to as an outflow from investing activities. Our last section then is the financing section. And when we do the financing section, what we find is that we borrowed some money from the bank and we paid some dividends. Comes down to a positive 39. We come down then and we do 30 plus 39 is 69,000. Minus 37 is a positive 32. So this is really just the sum of these three values. Notice also how we've been formatting these, where we do all of the individual pieces of information in one column, and then we kick the totals out to the next column. And that makes it a lot easier for us to follow the information so that we're not accidentally double counting or double adding something that's already been totaled. And so it just keeps things a little bit cleaner and a little bit easier for us to follow. All right. So we have our increase in cash of 32. We began with 5,000, meaning we ended with 37. And that should not come as a surprise because in the first part of this question, we calculated the ending balance to be 37,000. So I feel very confident that we have accomplished this correctly. Okay, and our last problem here, we're going to prepare the classified balance sheet. And so we'll do this relatively quickly. I'm sorry, my dog started barking. I don't know what's going on. I think she's fine. So we'll do the classified balance sheet here, which once again is in comparison to the unclassified balance sheet. You'll immediately notice some key differences. The first big difference here is that inside the asset section, we have a label for current assets. The next thing that you will notice is that the current assets are listed in the order of liquidity, which of course we remember to be the statement here, let's see if we can get a place where we can write, maybe over here to the side. Can she really invent something practical? And we said the C, of course, was for cash. She represented short-term, so we'll do ST, investments. Really was our receivables. Invent was, of course, inventory. Something was our supplies, and then practical was our prepaid expenses. And so this is what we ended up with for our saying. And it hopefully allows us to keep these things in order. So once again, we said liquidity was the speed at which something can be converted into cash. Well, clearly cash is already cash, so it wins. So it always goes first. Oftentimes you will see this called cash and cash equivalents, where cash equivalents is defined as something with an original maturity date of 90 days or less. So something where you bought it and the entire maturity was less than 3 months, then you get to include that as cash on the balance sheet. Okay. At any case, or at any rate, we've now covered the first big distinction, is this split here with current assets. So we now go through the information they gave us. We have cash, accounts receivable, and inventory coming out to total current assets of $52,000. For our long-term assets, then, we had two. we had equipment, and this says net. Now, what that is net of, we will talk about more in chapter 3. But for now, we can just say equipment net is 75. It's much like net pay, how you have a gross pay number, which is larger, and then you take out some stuff and that gets you to net pay. We'll talk about what that stuff is that comes out as it relates to equipment in chapter 3 in more detail. It is related to depreciation though, so we'll start there. All right. We next have operating leases, which once again, I do not have any idea why this is in a principles text at all. This is fine at this level, but there are plenty of other items we could have included here that don't open the can of worms that leases do. But in any case, leases pop in here, which gives us total long-term assets of $80,000. And then our total assets are the sum of the 52 and the 80. So 52 plus 80, of course, is $132,000. Next, we go through, we do our current liabilities. We had 3, accounts payable, salaries payable, interest payable, all having that keyword of payable, all being due within less than a year. And so we see our current liabilities are only $24,000. Finally, for our liability section, we only had one long-term liability. It was indeed notes payable for $30,000. And so we then take the 30 plus the 24. So we do 24,000 plus 30,000, and we get 54,000 for total liabilities. Coming down then to our last section here, we have stockholders' equity. Now, common stock was given to us directly as 50,000. What was not given to us, if we go back, was retained earnings. To get the retained earnings, we have to actually come back, and they tell us a few things. They tell us, let's see, what all do we have here? Prepare a balance sheet. Retained earnings. We're going to start with our total assets, which are $132,000, because once again, we know assets are equal to, so if we come in, we can say assets equal liabilities plus stockholders' equity. Well, we already know the assets are 132. We already know the liabilities are 54. Then we know the common stock is 50 because they told us that here. That means the only thing we do not know is retained earnings, and we can figure that out by simply doing this subtraction and getting $28,000, which then allows this all to balance nicely. Once again, oftentimes students like preparing the balance sheet on the exam, largely because it must balance. So if you have made a mistake, you can often locate it because your balance sheet will not balance. In this case, that wouldn't be as helpful because the way to solve the balance sheet was to plug it. But oftentimes, I will give you all of the information necessary in one way or another. You may have to solve a little bit, but it likely will not be in a plug fashion on an exam, though it could be. But that way you have a better ability to check yourself, as they say, before you wreck yourself. And so hopefully you've enjoyed this discussion. Going over the financial statements is a little bit of a shorter lecture than if we were to meet in class. So hopefully you take the extra time and spend it doing something else accounting related that you enjoy. I know it's probably hard to limit it to just one or two things because there's so much to be enjoyed here. But if you do have questions, once again, I'm always happy to help out. I hope you stay safe. I hope you watch this at a time when it's convenient to you and you can really dedicate your time to it. But in the meantime, I hope you stay safe. Hope you stay warm. And we'll see y'all when y'all are back on campus. Thank y'all so much.